Hey, it's Tom here and welcome back to the channel. So Warren Buffett, widely regarded as the greatest investor of all time and the man with a track record of close to 70 years now producing north of 20% per year returns, has in many ways been a victim of his own success when it comes to continuing to produce very high returns. He's managing so much money at this point and he's so rich that the universe of potential investments has kind of shrunk and got smaller and smaller and smaller over time. And this was really the main reason that we saw a big strategy shift from Warren Buffett in the 1970s and 80s. We saw him move from Ben Graham's cigar butt style investing, buying very small companies that are just statistically very cheap, not necessarily caring that much about the business, to eventually transitioning to buying higher quality companies that have better growth prospects that he can hold for a longer period of time. And this is where we saw the See's Candies and the Coca-Colas and the Geicos and eventually the Apples and so on turn up in the Berkshire Hathaway portfolio. And increasingly, the problem now is that he not only has to invest in the high quality companies, but he also has to invest in the absolute largest high quality companies. I've done videos on the channel in the past, kind of breaking down the fact that I really believe that Buffett only has about 30 companies or so globally that he can really invest in at any sort of reasonable scale in terms of putting a high proportion of his portfolio into one particular company, which he historically has really liked to do. Buffett famously said that if he were managing smaller amounts of money, and by this definition, smaller amounts of money really meant not billions of dollars, maybe millions or tens of millions, which I think for most people watching this video, we're probably not going to run into that issue of having billions of dollars to manage. Buffett said if he were managing smaller amounts of money, as he described it, he would be fully invested. He wouldn't necessarily have a lot of cash around like he likes to do at Berkshire Hathaway now, and he would probably be very concentrated. He would probably have about 50% of his portfolio in his single best idea. So in this video, I basically want to give you my thoughts on that philosophy. It's a ballsy strategy, which really means that if you want to bet big on one particular company, you really do have to be right. And I just want to kind of talk through some of the considerations around allocating different percentages of the portfolio to different stocks and my kind of thoughts on that, and the reason why I don't follow that strategy of putting 50% into my best idea. But before we get into that, we do have a sponsor for today's video, and the sponsor of this video is Hatch. Now, Hatch have been my personal broker of choice for me as a New Zealander looking to buy shares in large US companies. I've been using Hatch for over a couple of years now. Really switched across because of fees predominantly. I was paying excessive amounts of money to buy shares in the US before Hatch was around, and I've saved a lot of money kind of on fees ever since switching across a couple of years ago. But one of the other cool things that Hatch are always doing is trying to get some really good discussion out there and try to educate investors as much as they can in order to allow them to make the best decisions for their particular investment portfolios. And this Thursday, they are actually hosting the great debate of property versus shares. I think in New Zealand we've kind of got two camps at the moment when it sort of comes to property investing. We've got one camp of people who are sort of already on the property ladder, have done quite well over the past few years, but are sort of reviewing some of the new regulations that have come in with rental properties and so on over the past couple of years. And we've also got the people on the other side of that equation who are perhaps still looking to save a deposit to purchase into their first home and are looking for alternative investments. And I'm kind of in the middle of these two things at the moment personally. I was actually just spending the last weekend going through several open homes and looking at a property to buy myself. So it's going to be a really interesting debate. We have two superstars of the New Zealand investing scene with Darcy Angaro, who many of you may know from the NZ Everyday Investor podcast. And we also have Natalie Ferguson, who is one of the co-founders of Hatch. So that debate is going to be hosted this Thursday, the 29th of July at 7 p.m. local time here in New Zealand. I will leave all the information down in the description below if you're interested in registering. It's completely free and it should be a very good balanced discussion, hopefully. So I'll certainly be checking that out personally. And again, if you're interested in checking that out, all the information is in the description below. Okay, so portfolio concentration versus diversification, how much to have in your best idea versus your second best idea and third best idea. Should you have money in cash? How do we look at this sort of equation in general? Or should we just throw that all away in terms of trying to figure out individual stocks, and should we just diversify across an index? It's a really interesting topic, and it's one that we actually covered on the Punch Card Investing YouTube channel on a live stream a few weeks back. And it was really interesting to see where the five of us sort of agreed and where the five of us sort of differed somewhat as well. I think there were a few sort of core underlying themes where we were all pretty much in agreement. I don't want to put words in any of those other guys' mouths or speak for them in this video, but there were some core areas where I think we mostly agreed. And there were some areas where we actually differed as well. And I think a lot of it has to do with your own sort of personal goals in terms of investing, your own kind of risk tolerance and ability to maybe stomach a bit of volatility as well. Because if you're just putting a lot of your net worth into one or two stocks, your portfolio returns are going to be very, very volatile. Whereas if you are more diversified, you're probably going to be a little less volatile. But even that said, stocks in general and stock market in general can move around a fair bit. So even if you are quite diversified, you still need to have the appropriate level of stomach to be able to handle that as well. So this is basically my own personal framework. Now, anytime I'm looking at sizing a position in my portfolio, so, adding a new stock to the portfolio, there's a few kind of key considerations for me and a few things that I really want to achieve by putting that into the portfolio. So the first thing I want to achieve is really a focus on downside protection. So I really need to understand what is sort of the worst case scenario for this particular stock that I'm looking to put into my portfolio. What are the chances that I think I'm going to experience a permanent loss of capital, that I'm basically going to lose money on that investment? If everything goes wrong and it just doesn't play out very well, what is the overall impact to that position? Is it going to be down 50%, 100%? Is the company going to go bankrupt? What's a reasonable kind of max downside scenario? And that's kind of the sole driver behind how big I will make a position. So if I think that downside is as close to zero as I can reasonably get it, that's a position that I'm willing to make a larger chunk of the portfolio. And on the other hand, if I find an investment which I think has a lot of upside potential, but also has quite a bit of downside, hopefully the upside potential is far outweighing the downside risk. But in a situation like that, I would be more inclined to make it a smaller percentage of the portfolio. And for me personally, there's also sort of an upper limit in terms of the absolute size that I will sort of size up a position. So let's say that I can find a stock which I think has a very muted downside and a pretty good upside. Largely when there's muted downside, the upside kind of takes care of itself in my experience. But let's assume that I've found a particular stock that kind of ticks all the boxes for me in that department. Now, basically the largest percentage allocation in my portfolio that I will give to that particular company is about 20%. There's no sort of hard science or anything behind that particular number. That's just kind of where I've tended to find myself kind of shifting to. If I can at my most concentrated still have about 5 stocks in the portfolio, that's an area in which I'm pretty comfortable. But all 5 of those stocks would have to be like very limited downside, reasonable upside, and I understand all of them very well. They're squarely in my circle of competence and so on. So I think 20% is about the upper limit, and I guess the lower limit in terms of how I would size a position is probably something like 5%. So this is something I've done kind of recently with one particular company. I sized it a little bit smaller. It was a more uncertain position and perhaps slightly riskier as well, but I still liked the risk reward kind of proposition with that particular company. But on that kind of smaller end of the spectrum, I really wouldn't be comfortable with having, for example, 25% positions. I think that's frankly just too diversified for me. I know there's a lot of hedge funds and mutual funds and so on out there that own 100 companies or 200 companies. And frankly, I think they're not really investing in underlying businesses, focusing on fundamentals a lot of the time. I don't really believe that those people running those funds genuinely understand 100 or 200 companies. I think a lot of them probably can't even name that many companies in their portfolio. They probably can't even tell you half of them, let alone tell you what's happening with the underlying business and, give you their thoughts on where the stock's trading relative to its intrinsic value and that sort of thing. So it's a bit of a balancing act in that way. I want to be concentrated enough so that if I'm right, I really benefit from one individual stock. But if I'm wrong, I don't want to be eliminated from the game. So, a famous quote by Charlie Munger is that any number multiplied by 0 is still 0, which is very true mathematically. So no matter how much money you have, if you bet it all big on one particular investment and that investment goes to 0, you're now out of the game. And that's not a situation that I want to get myself into. Now, one of the other bits of information that really prompted me to make this video in the first place was actually a podcast I was just listening to yesterday between two individuals, Bill Brewster, who some of you may recognize from Toby Carlisle's Value After Hours podcast. Bill actually has his own podcast called The Business Brew, and he actually, in one of his earliest episodes, had a guy called Mike Mitchell on the podcast who goes by @IgnoreNarrative on Twitter. Now, this is an older episode, and this is actually the second time I'm listening to it. And Mike Mitchell is formerly a hedge fund analyst. He was involved in an activist-based hedge fund for a while. I think he's floated around a few different hedge funds over his time, but he's now basically retired and managing his own money. And he is someone who likes to take very, very concentrated bets. So, for example, he did that with QRTEA, and that was the company that they were describing on this particular podcast episode. So, looking at QVC, you may know QVC as the infomercials that you see on TV all the time, basically selling products to people sitting at home and just watching TV. And the average consumer from this business spends about $1,000 a year with QVC as well. So that was a company that he bet really big on, and he has a fairly similar philosophy to myself in terms of focusing on the downside protection first and having that worst case scenario downside really directly influence how much money he's comfortable putting into that investment. Now, Mike Mitchell is more comfortable than me in terms of loading up on a high conviction idea and making it a really large percentage of the portfolio. But QRTEA/QVC was actually a really good example. So with that particular stock, and this is not a recommendation or anything like that, but with that particular stock, when he first invested into that company, they had announced a special dividend. They were also spinning off some preferred shares and doing some things with debt. But at the core of the thesis, he was basically getting about 45% of his capital back almost immediately. So he was investing at $10 a share. He was going to get about $4.50 a share back. So he's really only in that stock about $5.50 after getting that capital back. And then it was basically an analysis of what is remaining and what am I kind of getting for my $5.50. And what he found was that in his view, QRTEA/QVC was trading at about only 3 or 4 years worth of free cash flow. So a very, very cheap stock, assuming the business didn't just deteriorate rapidly over the next few years. So in his words, he really only had to be right for 3 years. And that was a bet that he was comfortable making with a large chunk of his portfolio. And that too, for me, has always been one of the attractions to sort of the deep value style of investment. So looking at these weird little beat up companies trading at very low PE multiples is the fact that you can sometimes buy some of these things for 3 or 4 or 5 times earnings, and assuming that the earnings aren't going to fall off a cliff, and that frankly is the sole job of you as an investment analyst, to try and figure out whether you think that's going to happen if you're investing in one of these companies. If you can get yourself into a situation where the multiples are cheap, you think that's probably not going to happen in terms of this big drop off in earnings, you can bet really big, because you only have to be right for a short period of time, because you're getting your money back in 3 or 4 or 5 years if it's trading at that sort of multiple. And when you sort of compare that to some of the more high growth stocks that are trading at very high multiples, that is a situation where you have to really be right for a longer period of time. So if you go and buy a company trading at 30 times earnings, you have to be right for maybe 15 or 20 years, assuming that it continues to grow. If you're not right and it never grows, you're going to get your money back in about 30 years' time, which is a pretty anemic return, and you would certainly have hopefully been better off investing in an index at that point. So you really have to be confident about the ability for that business to grow, and you have to be confident about the ability for that business to grow for a long time. So you have to be right for 5, 10, 15, maybe 20 years if you're investing in one of these really high multiple companies. And that's not to say investing in those things doesn't work. They can clearly work very, very well. It's just kind of a different bet to investing in a low multiple business where you're going to get a lot of capital back very, very quickly. So that's really my view on portfolio allocations. I'm willing to bet maybe up to about 20% of the portfolio roughly in one particular stock, but it really has to tick a lot of boxes, and I'm willing to size as low as maybe about 5%, but I really don't want to have a lot of 5% bets because that just gives me a huge number of companies to keep following to the point where I don't think I could do those individual companies justice in terms of keeping up with them and trying to make good investment decisions. And if I really don't have a basket of stocks to fill the portfolio up with companies that meet those various criteria, then I will be willing to sit with a portion of the portfolio in cash. So that's kind of where I've come to with this whole allocation discussion. It's something that I'm sure will continue to evolve over time. It's changed even in just the last year or two for me personally, so it may continue to change moving forward. But I do hope you enjoyed the video. If you're willing to share any of your own thoughts on portfolio allocation, concentration versus diversification versus how much to have in cash and so on, I'd certainly be keen to hear your thoughts down in the description below. Again, if you're interested in the great debate of property versus shares that Hatch are hosting this Thursday evening, that will also be linked down in the description below. But that's it from me for this one, and I will see you in the next video. Cheers.